Hey, what's going on, guys? We are going to make a lot of money in 2023. I am confident, I am sure about it. And so far, the market is off to somewhat of a volatile start. Looks like it was going to have a green day. Now we're popping a little bit lower. But what I want to cover in today's video is going to be iron condors, because iron condors are fantastic for making money in all environments. I currently have an iron condor on Tesla. And basically, an iron condor can benefit a lot from volatility. Even if the stock goes up or down, as long as it stays within a range, an iron condor is going to be profitable. So I've been using iron condors for a very long time. And in fact, I think it's one of the most overpowered and strong strategies for growing a small portfolio. I just started opening up iron condors again, and I have a lot of plans to open up iron condors in 2023, depending on where the market goes. But specifically, I think using Tesla as an example is perfect for an iron condor, because Tesla is very volatile. It does not really have an established trend. It used to be going up, then it crashed, and now it's very volatile. However, it is actually somewhat range bound. So let me go ahead and open up Tesla. It's down 8% on the day. However, one day it's up 8%, the next day it's down 8%. You can see that the trend is very, very bearish. And I have not been in Tesla for a very long time. You can see right here that I have call credit spreads, and I've recently opened up an iron condor. I have not been in the stock since it was $210 per share. I made that video. I got a lot of hate. I actually had to take the video down, unfortunately, because, well, it's difficult to speak the truth sometimes. People don't want to believe you. But, now that that's $100 away, I feel confident to say that I made one of the best decisions of 2022 by selling Tesla. But I do think there's a lot of money to be made by Tesla. I also do think that Tesla is a good long-term investment, but you really have to get in for the right price. If you don't pay the right price, it doesn't really matter, because paying the wrong price is going to hurt you. If you buy stock too high and it ends up falling, and then even if it has like 100% gain like Tesla, let's say that it doubles up to $224 per share, that's still not really a big gain if you ended up buying it for over $200 per share. So anyways, the current strategy that I'm running is call credit spreads, and I can actually teach you both. I think it's really important for you to do both, because actually an iron condor is a combination of spreads. It's a combination of call credit spreads and put credit spreads. So let me just go over one thing at a time so you can make money in two ways in this video. So the two ways you're going to be making money, starting off with call credit spreads. So first of all, 260, 280, and then I have the 280, 290. But honestly, they have both made a lot of money. This is worth a penny and this is worth 2 pennies, and I'm up $1,650 basically. And this is not a big position. I am not trading a lot of money. I have really limited the size and the exposure that I have to Tesla because it is so volatile. But look, volatility actually is a good thing if you know what you're doing. If you know how to trade volatility, then you can use volatility to your advantage and actually make a lot of money. You can make weekly income, or you can also make big bets and have big returns. But for me, I like to stick to weekly income. That's literally all I do. I'm all about consistency because I want to live a very good and stable life rather than seeing big swings in my portfolio. So let's go over a call credit spread. I have 260, 280. But look, the stock right now is 112. So you're not going to be able to do the 260, 280 because I opened that up a little bit ago. Okay, I opened that up live in my Discord. So what I'm going to do now is I'm going to go to sell call option, and okay, that's going to be the Friday expiration. I do like to go out roughly 2 weeks or even more sometimes, to be honest. With a call credit spread, I can go out a whole month or even 6 weeks. So let's go out until February 17. That's going to be 6 weeks into the future. If you're watching this video in the future, listen, just copy the logic that I'm using, okay? The logic is pretty simple. If a stock is bearish and it's going down 9%, and then the next day it's up like 8%, next day it's down 9%, then the next day it's up 7%, the stock does not have a clear direction, although it is in bearish territory, which is why I think the number one strategy is call credit spreads, but then very, very closely behind, it's going to be an iron condor strategy. And I think both can be very good. You just have to pick the right strike price and the right expiration date, okay? So let's just start off with one thing first, okay? First of all, I'm going with February 17, 6 weeks out, okay? Then I want to pick an out of the money option. What I'm looking here on Robinhood is chance of profit, but you can use any broker you want. You can use TD Ameritrade, Fidelity, it doesn't matter, okay? I'm going to look at 145. I'm going to expand this. The delta is 0.2, which means that there's a 20% chance that Tesla is going to go to 145 next 6 weeks. I highly doubt it. This says 20%, but to be honest, I'd probably label this as like a 10% chance given the sentiment of Tesla, given what Elon Musk is doing, and given how weak this stock really is. So I'm going to go ahead and sell the 145, okay? Then I'm going to buy the 150. And look, I like to go for $500 spreads. You can do $1,000 spread. You can even do $100 spreads. For me, $500 is really the sweet spot because even if you have $5,000, then you can do 10 spreads of $500. That's $5,000. And in fact, because you're collecting premium, you can probably even do 11 spreads of $500 because you're probably going to collect about $500 worth of premium. In fact, I'm collecting about $63. So yeah, with a $5,000 portfolio, I can open up like 10 of these. Now, obviously, opening up 10 is not going to be smart risk management if you have a smaller portfolio because you don't want to be in just one stock. So if you have a small portfolio, then you might only want to do one or two of these positions. But check this out. You're making about $65. You're only putting up about $435. So super small account friendly. You can have less than $500 and open up this position and start making pretty good income on a monthly basis. Or this is actually 6 weeks out, but close enough. 6 weeks out, you can make $64 with less than 500. That's going to be roughly a 12% return in about 6 weeks. So about 2% a week. And that is actually my goal target. I'm going for 1 to 2% a week. Sometimes I can hit 3 during volatile weeks, but again, for me, I'm just trying to have consistency. I really have no interest in making 17% returns per week, and the next week is down, 18%. I have no interest in that at all. I just want consistent cash flow, and if that's what's going on, I'm happy with it. I don't like big swings because you can't really rely on big swings for your lifestyle. You need income and consistent passive income if you actually want to, be able to retire or just travel and not have to worry about having a 9-to-5 job or a business for that matter. Okay, so 12%, 2% a week, that's amazing. As you can see, the total credit is about $60 right here, saying 62. But if I click continue right here, you will see that the bid is 56 and the ask is 69. It would be great to get the 69 or actually the 67. But in all reality, you're going to have to go somewhere in between. So let me go ahead and put 5 contracts here. And for example, you're not really going to get filled for like the 69. You're going to have to go with like 64 or 63. Okay. If you're watching this in the future, then look, just pick an out of the money option. And the most important thing that you do is you find a delta that's around 10 to 20, honestly. But for Tesla, I'm actually going a little bit more aggressive than usual because with Tesla, I think that it's a really, really bearish stock. And in fact, as I've been talking, the stock continues to fall lower. The implied volatility is very high, so it's a very juicy stock to actually trade options on. I mean, it's extremely juicy because higher implied volatility means that there's higher premiums, and that's why you can make like 2 and sometimes even 3% per week in the premium that you collect. So anyways, this is the first thing that you can do if you are kind of bearish on Tesla, or at least even if you're a Tesla bull, but you agree that in the short term, the stock is unlikely to have a significant swing higher, okay? Now, let me show you how you are going to open up an iron condor, because actually an iron condor is kind of like magical. It actually brings you in double the amount of premium. So let me show you this, okay? I'm gonna go back from this. You can see here 145, 150, okay? Now what I'm going to do though, to open up an iron condor, I'm gonna go sell put option. So again, we've already established that it's unlikely Tesla will go up to 145 in the next 6 weeks. And that's why we're gonna keep this position open. And you'll see in just a moment, to open up an iron condor, it's still a call credit spread, but now we're just going to add a put credit spread to the mix. Okay, it's going to be pretty easy actually. But look, to open up a put credit spread, this is the complete opposite of a call credit spread. A call credit spread is basically saying that the stock is not going to rise too much. And if it does not rise too much, you're going to keep your premium and everything is going to be all great. And if the stock goes up to 145 or higher, you're going to have to close out that spread for a loss, okay? That's very, very out of the money. It's probably like over 20% out of the money. But now for an iron condor, we're going to keep this position open, but now we have to do the opposite, which is saying I'm going to start off with selling a put option and the stock should not reach that low point. So how low can Tesla go, okay? What strike do I pick here? And the strike that I'm probably going to expand first is going to be the 75. And I want to make sure that the delta is low. The delta is super low. It's 0.9. Now notice this. This is going to be really, really important, okay? it is important to understand why I'm going to pick a different delta, okay? For the call credit spread, I went with a 20 delta. For the put credit spread, I am honestly eyeing half the delta, or even less than half, at 0.09, so only a 9% chance. Why? That's because Tesla is going down, it's already in bearish territory, so it's likely to continue falling. I can also expand the $80 strike here, it's 12 delta, which is also pretty good, so honestly, I'm probably gonna do that. So look, if you do the 80 delta, the implied volatility is 96, very high. It's actually higher. Notice that this is higher than the 78 or whatever the call options were. And that is for a specific reason. And the specific reason is because option traders actually know that this stock is probably going down. There's more people buying put options than call options. And there's actually a lot more volatility, by like 30% more. That's because there's a lot more fear in Tesla than positivity at the moment. And the volume is 414. The open interest is pretty high. So look, what I'm going to do is I'm going to sell a put option at 80. So I'm going to collect $269. However, look, that's a very, very big amount of loss. It's a very big collateral. So what you have to do now to open up a proper iron condor is you sell one put, but now you have to do the same thing that you did with call credit spreads. I did 145, 150. What I'm going to do now is I'm going to do 80, but this time I'm going to go down to 75. I'm going to end up buying the 75. Notice here that there is a discrepancy, okay? So I'm selling for $265 and I'm buying for $2. So basically I'm collecting $63 more than I'm paying. So if I expand the $75 call option, this is a 9 delta, 100 volatility, okay? Because as you go lower, the volatility will increase. Although there is a smaller chance of this happening, that little small chance could turn into a whole lot of money. I mean, okay, so honestly, I'm not that bearish on Tesla. I don't think it's gonna fall to 65. But for example, if once in a blue moon, it did fall to say 60, this option right here would be basically a 5x. It would go from $1 to $5 in 6 weeks if it went to 60. Because if it went to 60, then intrinsically it would be worth about $5 because 65 minus 60 is 5. You're only paying $1. So that's why implied volatility will continue to rise as you go lower because, there's not a high chance, but if that chance happens, then boy, you're going to be like a lottery winner basically. So if I open up to 60, it's going to be even higher. The implied volatility just continues to go up. As you can see, there is still some volume here, which is kind of crazy, although it's not really indicative because, people are buying and selling. So this doesn't necessarily mean that everyone's super bearish, but it is interesting to see that there's actually 95 volume here. The delta is super, super tiny. So as I mentioned, it's not likely for Tesla to go down to 65. I don't think that's going to happen. Maybe the stock can go down to 80, but 65, probably not, okay? But there's a very, very tiny chance that something crazy happens. And if the stock were to somehow crash lower, then these options right here would gain a lot of value, insane amounts of value. It can go from $78 right here to $500. You can literally 7x, okay? And that's the dangerous part of, selling these type of options, which is not the best thing to do on a very, very volatile stock. But also, if you're going to be buying options, this is a super inconsistent strategy, okay? So I don't really recommend going that far out. But anyways, as you can see here, I've actually opened up a short iron condor and the return is very, very, very favorable. I mean, it is a 33% return. $600 divided by 1,800 is about 33%. It's about a third. Okay, so basically the goal here is that Tesla will stay between about, $80 on the low end to $145 on the high end. As long as that is the case, this position right here is going to expire. Now, it's very important to also understand how to manage and close this position. Okay, so let me talk about those two things and wrap it up. Okay, so when you open up this position, your goal is honestly just to have it expire and that's it. That's the goal, okay? Now, in between, if this option gets very volatile and the stock goes up to 145, as long as it's under, you're good. Although I do agree with you, it's kind of nerve-wracking. You're like, oh my gosh, is it going to break through one of my strike prices? Either on the high side or on the low side. Let's say it's going down to 85. You might start to panic. But listen, don't close because oftentimes what happens is a stock will bounce back and forth. The options will look really scary. But in reality, if you don't look at it, kind of ignore it, be patient, which most people are not, you'll actually end up having a pretty good return because the stock will bounce really low, but the next day it'll recover. So on a really bad day, you don't necessarily want to sell. And on a very, very good day, you also don't necessarily want to sell. You want to just be patient and let this position go until expiration. Now, I will say that if it goes to 145, there's a very clear trend of upward momentum, then you do want to close. If this stock sees 7 days in a row, 7 trading days in a row of negative 4% returns, and Elon Musk is doing something crazy and the news is very bad, and et cetera, really bad stuff coming up, and it's 7 days in a row, or like something like 5 days in a row, and this stock goes down to like 78, then okay, look, another trend has happened, and then you do want to close this out, right? But you only want to close out if a very, very clear trend has been established. If a very clear trend has not been established, then you just hold this position until expiration. And I always say the easiest way to manage a position is by doing nothing and letting that position end up closing out. That's the easiest thing for an option seller. If you're an option buyer, it's a lot more difficult. And if you actually want to learn how to buy leap options or call options profitably, make sure to check out this video right here.